All right, so this is a former student of mine. He sent me an intern. You can't see it. Let me just load him. So if you want this, email me and I'll forward it. I told him I don't quite know y'all too well yet because you're just now starting, but you're honor students, so I'm assuming you're well above average, probably in the top 10%. So here's a marketing communication outreach, 6 months, 20, 30 hours a week, or Brame Holdings. There's a job description, responsibilities. If you're a marketing major, it looks like it would be a really good. This looks like a really go-getter kind of start your own company kind of person who's would be a good person for just for networking, just to know a person like this. So if you're interested in that one, let me know. It's a really long job description for an intern. So any of y'all think you might be interested?
Yeah, let's take a look at it.
I mean,
You said it's mostly marketing.
This is a marketing one. I do have one that's a
For
finance. The second one, oh, which one did I do? Okay, the second one is more of a management, account manager responsibilities. So I don't know, it could be multiple, this could be multiple majors. So it looks like some accounting to it as well, compliance and some certain things. So it's looks like it's kind of overarching kind of responsibility. So if anyone want to see that one, and then the last one I got on my phone, this comes from one of my students who's working for a startup, really sharp student. Just I'd be interested in just so I could work with him. He's one of our stars. He's an honor student as well. He said, we are currently looking for an intern that could help source M&A deals. The role will consist of research, cold outreach, and some Excel work. I'm attaching a job description below. It's called Business Development Representative. So if you're interested in any of those three, just email me and I'll forward this one. I'll try to forward to you. So, any questions on any of those?
Yeah, what was that last one called?
Business research. It's a firm that does a lot of M&A, and so business development representative, or Upwork is the name of the company. Upwork.com. But I've got a few alums. I've had people say, yeah, I'm interviewing for a job and so is the one interviewing. I said, you should take it just so you can have him on your network. There are some people you just want them in your network. And so John Kim is one of those. Really sharp student. All right. One last quick, the role. Sebastian, Luke, Mariana, Natalia, no. Here, Brianna. Oh, it's Mariana. Anybody else I missed? I think. Right. All right, so let's get into this project and then we'll quick introduction so you can see the template. So we're working with a very specific template here. That's a really good template. So we're going to do financial statement analysis. Someone says, maybe you're a marketing major and your boss says, hey, we're looking at this new customer database firm, has good software. Can you analyze the company, make sure they're a legitimate company? You could do exactly this to be in good shape. Maybe you're a cybersecurity and you're looking at hiring some new firm, so it's possible your management would ask you to do some type of analysis. And this is the kind of thing you want to do. We're going to look at some key ratios. One thing to realize is these are generic ratios that work for all of your companies. When you get into the real life, every industry has their own ratios, very specific. I could give you a bunch of ratios that work in banking, work in insurance. The insurance ratios are very different than banking ratios. So, net interest margin, that's something banks have that insurance companies don't have, that Ford and GM and Walmart don't have. So every industry has their own ratios. We can't cover industry specific ratios in this class because there's too many of them. It's massive. S&P published a book on key ratios by industry. It was a massive book. It's just a lot. And you don't want to do that in undergraduate. What you want to do is figure out what industry you're going to work in, and then you work in it and you figure it out as you work in it. So what we're trying to get through is the process. However, the template still works for all of those companies. It's the categories I'm using work for all companies. It's just the specific ratios in each of those categories changes depending on the company. So the template works great. You just got to figure out what ratios to use. So ratio analysis, we're looking at the position of the firm and performance. We want to look at it across time, which you're going to see we have a lot of charts that show time. I like having a lot of history so I can just see where this firm been. Are they in a particularly weak position or a particularly strong position? Has something material changed? They used to be up here and then they've dropped down. What did COVID do to them? Have they recovered from COVID? You want to compare to peers in industry. I used to do it versus a key peer, but I don't do that anymore. I took the peer out, but you have the peer in there. So if you're doing UPS, you can go look at the FedEx numbers and specifically talk. You know, they look good versus the industry, but they're trailing FedEx. You can do that. You have the data, but I don't have that specifically set up. But you do have the industry in there. It allows you to compare firms of different sizes because the ratios adjust for that. So that definitely is a big advantage. There are rules of thumb of what's acceptable and what's not, but I'm not going to give you too many of those because it varies by industry. The only one, there's one I will give you, but for the most part, your rule of thumb is if a higher ratio is good, you want it trending up. That's pretty obvious. If they've been at 3% and now they're at 4%, that's good. If it's that kind of ratio. And the reason for that is, you know, let's take debt. How much debt the firm has? Technology companies tend to not have much debt, but a utility has massive amounts of debt because a utility has a lot of really good safe assets that are really good collateral for debt. So they can borrow a lot of money. It's no big deal. Tech companies, because their business is somewhat, you know, wishy-washy and up and down cycles, they tend not to borrow a lot of money. So is what's acceptable? It just depends on the industry. So what you're going to do when you look at your debt, you're not going to say, wow, that number is too high or too low. You're going to say that number is high relative to its industry, or that number is low relative to industry. So you assume that industry median's somewhat the norm. So we're creating our benchmark by looking at the industry norm, which is not a bad way to do this. That's the reason I said you want at least 20 companies so you have a good sense of where the industry is. All right. You have to be a little careful when you have ratios. If there's a zero or any, you'll see in the Excel, I had the not meaningful figures sometimes. So I'm doing a CAGR, which is a growth rate, an annual growth rate. You can't do a CAGR if the sign changes. If you go from a negative number to a positive number, there's no growth rate. It's just going to say NFF. And so some students say, what do? I don't have a growth rate. Then you just ignore the growth rate and you just talk about the numbers. They used to have X, it used to be negative 300 million, but now it's positive 500. You just talk the numbers. You don't have to worry. And you kind of talk about the history of the numbers. It started out negative 300, but the last 10 years it's been positive and it's been getting more, you know, you just kind of give the history of it. But the CAGR does give you some sense of the growth over time. And we tend to know annual growth rates, which is what a CAGR is, a compound annual growth rate. We can kind of think in annual terms. So if I tell you a firm's annual growth in revenue is 1.2%, does that sound like a great number, average number, mediocre number, below average number, 1.2%? That sound great? We know inflation typically is right, about 2-3%. So if someone's growing their revenues 1.2, they're not even keeping up with inflation. So that's not good. What if a firm's revenue growth was 11.2%? Sounds really strong. If it's negative, right? That's pretty obvious. So we tend to think if I say their revenues is up 70% since 10 years ago, then you got to think, well, 70%, but that's 10 years. So that's about 7% a year. You know, you have to do all this math. Whereas the CAGR helps you do that. Anybody know the formula for a CAGR? If you're a finance or accounting major, you'll probably do this 10 million times in your career. So we do CAGRs. Any guesses? So it's the ending value divided by the beginning value raised to the 1 over the number of years minus 1. That's the CAGR. We use it all the time in finance. Now this N is not number of years, it's number of growth periods. All right, so be careful on that. If you have 10 years of data, your N is going to be 9. Because for 10 years of data, you only have 9 growth periods. You grow from year 1 to 2, there's 1, 2 to 3, there's 2. All right. So if you're doing the last 10 years, if you have 10 years and your first year is year 1, your last year is year 10, your N is 9, not 10. Okay. So just be aware of that. But that's the formula, very popular formula. We call it the CAGR. Have you ever heard CAGR before? So the CAGR, so we'll use it a lot. You'll see it. You may not have a CAGR because of the time change in some places. You don't freak out. You just can't talk about it in that context. All right, so here's the template. I'm sorry. So here's the template we're going to use, except for the last one. I've taken relative value. We're going to talk relative value, but we're not going to put it in this first paper. But I'll talk some of it though. So I wouldn't memorize this. I would just know it. All right. Take it from your short-term memory to your permanent memory, just so you have a good template to work with. It's very, very, very valuable. So the first thing you're going to do is make sure they're a viable company, that they're not about to go out of business. So we talk about short-term viability. So we start with the short term. Are they going to be in business in 5 years? If the firm's going out of business, there's no real reason to go to step 2. You just want to see if they're going to survive. Once you assess that they're okay short term, then you want to start to look at long term, and there your focus is on growth. So short term's okay. They don't have too much debt. They're not illiquid. They're not struggling with cash flow. So they're a viable firm, but are they growing? So once you figure out they're viable, they're going to be around for a while, then you're thinking about how are they growing? If they're not growing, how could they grow? Are they going to move overseas? Are they going to shut down some bad stores? What could they do? So that's the second part. All right. Under the short term, we're going to look at liquidity. We're going to look at solvency. Liquidity is the hardest part of paper 1. Solvency is the easiest part. All right. And we're starting with liquidity. So just realize we're starting with the hardest part. So don't get discouraged. In fact, get encouraged and say, okay, I kind of get this. And he says the hardest, so I'm in good shape. Or I'm not getting this, but it's the hardest. So at least it's getting easier, you know. So we're starting with the hardest part. The long term, there's 2 places we look in particular. There are activity ratios and margins. Activity is about revenue growth. Is their top line business growing? Are they getting more customers? And in margin is, are they profitable? They may be getting more customers, but they're not very profitable customers. I may show you some. I read The Economist every week, which I highly, highly recommend. The Economist had some great articles this last week that's perfect for this class. They're talking about Apple getting more into services instead of hardware. And their hardware side, the phones, the computers, has a gross margin like 30%, but the services side has a margin of like 70%. And that's the part they're growing. So that's, you know, that sounds pretty good for Apple getting into a business that has higher margins. And then we'll bring it all together and do profitability ratios. You might have done this in your accounting classes, but we'll do it a little differently. I'm going to show you where I think the accountants get it wrong. Some things we need to break out correctly. We'll talk relative value. What relative value says is, once I assess the firm and say whether it's a good firm or bad firm, what's the stock market telling me? Does the stock market, I think it's a great company, but its stock is cheap. Or I think it's a horrible company, but its stock's expensive. Or I think it's a great company like Costco. I think Costco is a great company with a really expensive stock. So if Costco's stock is cheap, I might buy Costco, but then maybe something changed, made it cheap, something happened. I think Costco is one of the best run companies in the world, but the stock market loves it too. So we're not going to do this last part in paper 1. To get more precise, you got a rubric for paper 1. So there's 3 things, and this is for the exam as well as your paper. So you're going to do this for liquidity. We're going to look at cash from operations growth. We're look at net working capital requirement, which is where finance is the most disagreement with accounting. That's where you're going to have to really change your thinking. And then we're going to look at what are they doing with their cash flows. Are they paying dividends? Are they buying back their stock? Or doing capital expenditures? All right. Solvency, pretty easy. We're going to look at times interest earned and debt to EBIT. We're just going to ask, can they handle their debt? Do they have too much debt? Pretty straightforward. That one's easy. Then we're going to do overall assessment of the short term. So you have the two pieces on the short term overall assessment, and that's where we're going to go to a third party. We can look at their credit ratings, which is sometimes in your, like if your boss says, hey, can you go check out this firm, make sure they're doing okay? And you're doing a marketing project and you go look it up and they have a really high credit rating, you can probably tell your boss, you know what, they're probably fine because they're rated single A. That's a really high rating. You don't have to do a whole lot more work, but you might look at it. Are they growing? Those kind of things. But here on the short term, do they have decent liquidity and how's their debt situation? Then you get into turnover. Is their revenue growing? This is the dangerous one because it's the only thing on this list that doesn't have a graph, which means a lot of students forget to do it on the exam because they don't have a graph, so they forget to do it. So somehow put it in your notes. Make sure to talk about revenue growth because it's the easiest one on the entire list. That would be really sad, wouldn't it, if you forgot to put the easiest one on the exam? All right, and then we're going to talk about this one. It's kind of tough, and then an easy one again. And then we'll get into margin, gross margin, and net margin, which is pretty straightforward. And then we'll have an overall summary on growth, and then we'll have an overall summary on the company using return on equity. So you see how we progress through there. Now, from your standpoint, you have some easy ones. CFO growth is easy. Times interest earned debt is easy. Revenue growth is easy. ATO is easy. The margin's pretty easy. So you have some easy ones. You have some tricky ones. They're not impossible, but they're a little challenging. That's it. And then you have, I don't know what, I guess red, right? Then you have the hard ones. Net working capital, passive versus turnover. And a lot of students struggle with these last two. And the titles is just kind of a gimme. So the easy ones are easy, and you'll see why, because we're talking ratios where higher is better, and you just look at your firm. Are they going up? Are they higher than competitors? Real straightforward. Turnover, asset turnover, real simple. Hey, they're better than the industry, and they've been improving. You're essentially full credit. It's really straightforward. All right. They're better than the industry, but they've been declining the last few years. So the industry's catching up. The gap is closing. However you're going to say it, that's the kind of thing you look at. All right. So y'all getting a sense of where we're going here. So what I'm going to do is we're going to cover the ratios, talk about them on liquidity, and then I'm going to show you what I did for Walmart for liquidity. What I think would be ideal is if you're on Zoom with your data loaded, that if you have a question on something like I'm showing you Walmart, and it's like my company looks really weird, you could share it on Zoom and we talk about your chart and someone else may see that. So we'll try that and see. If you don't have your laptop today, bring it. If you bring your file and you're getting Cap IQ to work, I would copy and paste the Cap IQ page as values and use the value one so that you don't have Cap IQ calculating all the time. But we'll try it. We'll see if it works or not. So questions, comments? Does this make you feel more comfortable or more scared? So it look pretty straightforward. It's an obvious list. There's not like any, like it could be one of these 20 things. No, this is it. There's nothing hidden. All right, so let's start. So what you need to know is what ratios you use on each one, but that's pretty straightforward because you have a graph. With everything except for revenue, you've got a graph. So you just talk about the graph. Need to know whether higher or low is better. There's most of them higher is better, but there's a few where lower is better. Like we tend to like debt to be lower, not higher. Then talk about the trends and versus peers. So is it noise or something going on? So it's gotten a lot easier this year, but back in 2020, it got really rough because COVID, everything was off the charts. We were like, and then we're coming back from COVID. We're trying to figure out, COVID messed things up. You'll probably see COVID in some of your charts, just because COVID had a huge impact. And if you're doing Zoom, not only are you doing Zoom, how did Zoom look in second quarter of 2020? Pretty amazing. Yeah. How did United Airlines look in the second quarter of 2020? Pretty horrible, right? So they've come back pretty well. I think most of them are almost back to pre-COVID numbers, but yeah, you can have a year like that. Fortunately, we're far enough past that it should be out of your numbers and shouldn't mess it up too bad. And then we don't have rules of thumb really, so we're going to focus mainly on let the peers tell us that. And there's the CAGR again. So it's a good ratio, know how to use it. All right, so let's start liquidity. Liquidity has two components. One is how liquid the firm is in its operations. The second one is that the firm does have a liquidity issue, where can it go to get cash? We're going to focus on the first one and ignore the second one because the second one's really, really difficult to do. So the first one is, are their operations themselves liquid? Are their operations cash drainers? If their operations produces a lot of cash, that's a very liquid firm. If their operations needs a lot of cash, that's the firm that's going to borrow a lot of money, get a lot of support. That's going to be a problem. So we're going to look at that first, the actual operations. The second one is, do they have a line of credit they can borrow money? They have subsidiaries. We did this at USAA. We'd list every place we could go get cash in an emergency. We assessed it every quarter. We made sure the regulators were fine with it. But we're not going to do that in this class. You can do that for your company, but you have to really dive into the footnotes. They may say they have a $10 billion commercial paper program, but they've only used $2 billion of it. That means they have another $8 billion they can borrow in an emergency. That's the kind of thing you're looking at. We're not going to do that in this class. And y'all stop me if I say something you're not sure about. So the operating cycle is essentially from the beginning of their entire process to the very, very end with their customer. So maybe the beginning of the process is procurement. They buy raw materials. The second part of the process is the raw materials come in and they do something with it. They make something, they build a car. So maybe it starts by buying steel. The steel comes in, they produce a car, then they have to market it. Then they have to sell it. So there's the sell process. Then they have to distribute it to the customer, and then they have to service the car afterwards. So it's that entire process. And one thing I really I think we talked about this earlier. If I were you, I would do some reading on the value chain. Value chain analysis. I think we talked a little bit about that. Are y'all familiar with that? Who invented the value chain? Michael Porter. Does that name sound familiar? Here's Harvard Business talking about it. If you go to images, you'll see one. They all look the same. So this is a typical, have y'all seen this before? What class did y'all do that in? Maybe a strategy class or management class? Or, yeah, so it's a really good source. So essentially what we're talking about operations is you have inbound, so you have raw materials coming in. You got to build something. You have outbound, marketing and sales and service. And that's the firm's operations from beginning to end. Does that produce cash or does that eat up cash? That's really what you're looking for. Try to incorporate this into your library analysis. We're not going to specifically do it in this paper, but it's a good way to think about it. You have your other support activities like infrastructure, procurement. And in here they say margin. What they're saying on margin is it profitable or not? Those are the primary activities. And really what you're doing in the value chain is a firm has to be great in one of these and at least even in everything else for it to be a viable firm. They can't just be mediocre in all of these things. They've got one of these they got to really excel at. So, some firms are like marketing and sales are really good at that. Some firms are really good in their operations. Some firms are really good at procurement. It just depends on the firm. Where would Tesla be strong here? Well, you could put them up there, but that's probably going to fall down to operations. Do they really produce a superior car? So you can debate that. Does Nike produce a superior shoe, or is Nike just really good at marketing and sales? When you're wearing Nike shoes, do you score an extra 10 points or not? Does it make that difference? So those I've seen them Nike shoes that are what, $10,000 or something. I was like, yeah, I don't know why you may pay that, but so it's a really, really good way of thinking about it. Supply chain management. Michael Porter does have a book you can read on it if you want to get into it. But that's operating cycle. So you start with the suppliers. Usually firms pay their suppliers. So right, if you're buying steel, you got to pay the steel producers. Then it comes in, you got to produce the cars, so you got to pay your workers. So you're out of cash, right? Cash is already gone. And then you got to market it, send it to the car dealerships. You got to pay them commissions. And then finally, the person buys the car, but they don't buy it with cash. They have a 5-year loan. That's a pretty negative cash flow, isn't it? So you're waiting, you buy the steel today, and then like 6 years later, you finally get all your cash back. So that's a very, very, very cash negative operations. So the operating cycle, generally for most firms, not for all firms, generally produces negative cash flow. So here's the key for this right here is this net working capital requirement. Right, it's the hardest part of paper one. A lot of students struggle because this is where we most disagree with the accountants. So what is a net working capital? What is working capital? There are working capital assets and there are working capital liabilities. The working capital assets is all essentially the current assets except for cash. It's all those current assets that are directly tied to your operations. So accounts receivable, well, that one's pretty obvious. You sell something and your customer doesn't pay you, they're going to pay you in the future. That's an accounts receivable. Inventory, pretty obvious. The sell stuff, you're going to have to create inventory to sell. Prepaid expenses, you got to pay your rent in advance in order to have a store open. So that's an asset tied to your operations. On the liability side, accounts payable, that's you're paying your vendors, you're paying whoever you're buying your raw materials from. Accrued expenses, that's your accounts payable, but to your employees and others that you haven't paid yet, but you're going to pay them in the future. And then a huge one, we'll talk a little bit more about this, unearned revenue. Now, which of these are good and which are bad? You want a whole bunch of these, or would you want a whole bunch of these? Which would you rather have? According to the accountants, you want more of the assets and fewer of the liabilities. According to finance, it's the exact opposite. Finance hates these things, and finance loves these things. I'll have to show you, I have to play the business breakdown on AutoZone. We'll talk about AutoZone because it's a good example. So in the AutoZone business breakdown, it's really, really interesting. I'll talk a little bit about here. I'll let you listen to it if I can find it. I got it on my YouTube channel. But AutoZone is a firm that is going to make sure they have an inventory whatever you need. You walk in, they're going to have it, which is really tough because there's all these cars, there's all these different models, all these different washer blades. And so the guy interviewing says, wow, they must have a really high working capital. And the guy says, no, it's actually excellent. They actually have negative working capital. An accountant would hear that and say, what? Negative working capital? That's terrible. But he's saying, no, that's good. Negative working capital. How can you have a lot of inventory and this be a negative number? So here's what AutoZone does. They have a lot of inventory, but when they buy inventory from their suppliers, they don't pay them. They give them an IOU. And you think the suppliers would be really upset about that, but they're not. Because AutoZone is such a high quality company, what did the suppliers do? They have this IOU from AutoZone. They go to their bank and say, I have this IOU from AutoZone. The bank says, yeah, give us that IOU and we'll give you cash today. So you've got $1 million that AutoZone owes you. We'll give you $995,000. You give us the IOU. So the vendor's happy. They get their cash with a little bit of a discount. So what happens to cash flow for AutoZone? They get their inventory, but how much cash leaves the store? None whatsoever. And then they tell their vendors, hey, we'll pay you over the next 2 or 3 years. That's a wonderful model. But the accounting ratios, it looks terrible. Why? Because they have this massive accounts payable. But that's good for them because it saves them cash, all right? So you have to listen for that working capital. You're going to hear it very, very differently than what the accountants say. So let's talk about this one. What is unearned revenue? That's when your customer pays you, but you haven't done anything for them. When's the last time you did that? You pay for a product and you may not use it for another 6 months.
Gift card?
What?
Gift card?
Gift card's a good example. That's an unearned revenue. What's the biggest one you've probably done if you've been traveling?
Flights.
Huh?
Like flights.
Flights, exactly. The most wonderful thing on United Airlines balance sheet is unearned revenue. So you buy your ticket today, they get their cash today. What interest rate did they pay you on that money you just loaned them? 0%, isn't it? How much would you borrow if you could borrow at 0%? Oh, you could borrow. So United Airlines has a massive liability called unearned revenue, and it is wonderful. You just loan them money at interest free, and it's a wonderful part of their models. In fact, this is probably the best. Airlines is a horrible industry. Thin margins and high capital requirements, but at least they got this. They have this unearned revenue, so they get your cash in advance, and they love it. It's a wonderful thing. So that's the unearned revenue. Gift cards is a good example as well. You know, you get money today, and you're hoping they lose the gift card. Someone gave me a gift card to a restaurant once, and I found, oh, I forgot all about that. And I run out, and the restaurant was out of business. Like, wow, that's great. They got my cash or got their cash. But that's the unearned revenue. All right. So you actually want this number. So you add these, you subtract these. You would like this number to be as low as possible. The lower it is, the more liquid the company is. Right? If it's negative, what that's telling you is their operating cycle actually produces cash. Right? So you're looking at a few things. If it's negative, the firm is probably very liquid. If it's positive, then it kind of depends on the trend, because most firms, this is a positive number. So if it's positive, that doesn't mean they're horrible. Some students get a little exaggerated on their paper. Say, oh, it's positive, they have horrible liquidity. Not necessarily. That's just normal. Most firms, that's a positive number. So you're looking then at the trend. How bad is it? Is it getting more positive, which is bad? They're getting less liquid. So if they started at 500 million positive and they're now at 300 million, it's still a positive number, but it's gotten better because it's come down. All right. Now, what I'm going to do is take the net working capital and divide it by something. So you can look at it over time. I used to divide it by cash from operations, but I don't do that anymore. I divide it by revenues. And the reason for that is cash from operations can be a volatile number. So sometimes that ratio can be moving around, not because of net working capital, but because of something else going on with cash from operations. So when I use, you'll see in the ratio, we're going to use revenue because it gives us a more stable number. And revenue probably makes even more sense because a lot of these are related to revenue. All right, questions on this, because this is really, really critical.
Would you say like, so what if the company is like in the negative, but they're trending towards the positive? What would like?
You're getting less liquid, yeah. And then you want to look and see why is that? Is it because their inventories are growing faster? So we're going to talk about something called inventory turnover. In that case, their inventory turns probably declining. They're not turning inventory. It could be receivables. Most of your firms, it's not going to be receivables. You know, how many of y'all owe money to Walmart? You might owe money to Bank of America, but you probably don't owe money to Walmart. So, you know, Walmart has a really small receivable, but a pretty big inventory. So it's most likely, and I'm going to show you in the Excel, we have actually something that's going to help you with that. It's going to show you which of these things is causing the problem. All right. So a positive number means operating cycle is a use of cash. A negative number means it is a source of cash. Higher is, I shouldn't have said bad. I'm going to change that. Less positive, less good. Can I say that? I don't want you to think bad, because a better way of saying is positive is normal. Most firms are positive. A higher rising trend does mean worsening liquidity. So if you go from a negative 500 to a negative 200, you're getting less liquid. If you go from a positive 500 to a positive 700, you're getting less liquid. Okay, so anytime the number's going up, you're getting worse. And essentially what the firm's trying to do is trying to match these up as best as they can. What you don't want them doing is using a lot of short-term debt to try to finance this if this is a pretty permanent need. So the only time you want to use short-term cash, short-term debt is if this working cap requirement is very seasonal, like in December because of the holiday season. So if you have a very seasonal working capital requirement, that's when you can use short-term debt to handle that. But if it's a more permanent, Wall Street hates short-term debt. It makes your cost of debt very, very volatile. All right, so cash and short-term debt is how you manage the cycle. So if you're producing cash through your operations, it's going to give you a lot of cash. If you're not, if it's a positive number, so you have a illiquid, you probably have to borrow money to manage this. Firms later in their life cycle, that's usually going to be a source of cash. Now, how do firms handle this? Just-in-time inventory is one way you do it. You try and get the inventory as small as possible, so inventory shows up right when you need it. That's going to reduce that inventory and make you much more liquid. So I just said this, if working capital is seasonal, you can match that up with short-term debt or cash. If it's more permanent, you should use long-term debt and equity to fund that. If it's mixed, you want to kind of watch the two. So we're not going to get too much into this, but just realize Wall Street hates short-term debt. If a firm suddenly has a lot of short-term debt, Wall Street gets really, really nervous. When I started as a security analyst, I was so scared to death. I had my first meeting with the real estate investment trust. Company came in and was like, okay, my boss, I better ask a good question. And it's like, I don't know what I'm talking about, so I'll be lucky. So they came in. The one thing I noticed with the real estate companies, they had a lot of short-term debt. So it's like, okay, ask me my question. It's like, why do you have so much short-term debt? And he goes, oh, great question. So, I'm not saying another word for the next hour. So I got my one question in, but it didn't make sense. If you got a 10-year office lease, you don't want to fund that with short-term debt because you got the lease that's fixed. And if interest rates rise, your cost of debt's going to go up. It's going to be a bad mismatch. So he said, and he was like, yeah, we're going to fix that. It's temporary. We're going to get that off. He's like, man, you kind of caught our big problem there. So long-term financing is long-term debt, your stockholders, retained earnings, those type of things. All right, I don't think I get into much in this one. Why do we hate short-term debt so much? When you use short-term debt, you're constantly going back to Wall Street to borrow money. And if you get something like the end of 2008, when markets just froze, you can go out of business just because no one's loaning money. It's just a completely dead market. Or you can have interest rate risk, which is what we have right now when the Fed's raising rates. You know, think about it. Short-term debt used to cost you like 1%. Now it's probably costing you 6%. So your costs are going up sixfold. You probably wish you had locked that in 5 and 10-year debt so you wouldn't see your costs rise so much. I've been watching the U.S. government. It's kind of scary looking at our cost of debt at the U.S. government side because they were borrowing money at 1%, 1.5%. Now it's 4.5%, 5%. So the U.S. government's cost of debt is going up fourfold. That's a huge, huge increase. So short-term debt creates issues for companies. I remember several years ago, the General Electric, their CEO went out and borrowed a lot of short-term debt. And we all knew she was doing it because she thought interest rates were low and she's going to take advantage of it. And their stock dropped. The next day she was out apologizing. No, that's not what we're doing. She was trying to save and she had to undo all of that. Wall Street does not like short-term debt unless you have a very specific need right at the end of the year, for holiday shopping, those kind of things. So how do you change the working capital cycle requirements? You manage your receivables, your inventory. Can you get your customers to pay you faster? That'd be great. And you have less inventory. Now, 2020, we learned the problem with just-in-time inventory. If the inventory shows up right on time and then there's a supply shock around the world, you're in a lot of trouble. Stuff just doesn't show up. So yeah, that's the downside. We have some management majors in here, right? That's going to be a big part of your job is inventory management, stock outs, those kind of things. You'll be studying that. You don't want to have a lot of stock just sitting there, but if you don't have it sitting there and, you know, there's a supply chain issue. So I know there's a bike shop that I've spent over $30,000 at this bike shop in the last few years. So they know me really well. When I walk in, they're all smiling because they know I'm about to waste a lot of money. But during COVID, I walk in, I was worried that they were struggling. I said, man, I hope you guys aren't going out of business. It's like, no, this is the best 3 months we've ever had in our history. We've sold every single bike we have. We have no more bikes left and we can't get any bikes. I was like, wow, that's pretty amazing. So yeah, they couldn't sell anything because they had no inventory. And so, you know, so you have to watch that, but that is how you manage it. You try to get the inventories down as far as possible. You try to pay your vendors as slow as possible. If you can get away with it. I did this at USAA. We had one bank is our biggest bank and we paid, I don't know, it was like a few $100,000 a month. But our contract said I didn't have to pay the bill if there was any errors in the bill. And there were always errors in the bill every single time. So I would get the bill and it'd be off like $2. It's $300,000 bill. It's off $2. So I'll call Dave, go, Dave, y'all charged us 77 cents. We negotiated 75 and he says a bunch of expletives, not at me, but at his billing department. Says, I'll fix it. That gives us another week, another 2 weeks. We find it's not my fault. It's their fault. The contract says that. So yeah, I'm essentially borrowing money from them at free interest rates. So some of y'all will on the accounting side will be on the accounts payable side. And that's, you're not trying to rip off the vendors, but if you can pay them next week and not this week, you pay them next week. There's no, you're not doing them favors. Hey, can I pay you early? Like, yeah, I guess if you want to. You're going to try to reserve that liquidity to your benefit. Industry have their own influences, definitely. So you'll definitely, like I mentioned with airlines, unearned revenue is a huge deal for airlines. The big industrial firms like Boeing, this is a big part of their process because it takes them 10 years to build a plane. They're going to have to really manage that cycle very clearly. And then the sales process, firms that are growing really fast can have serious liquidity issues. You have to watch that. I was working with a small software company doing great. Boy, they were selling so fast. Their sales reps were out there selling. And the only problem was the contract said if there's any problem with the software, you don't have to pay us. And it was a brand new software pack. It worked really, really well, but it had problems. So none of their customers were paying them. Their revenues are growing fast, but they had no cash. And the CFO went out to the sales force and said, you know, those commissions y'all really want, you better go back and fix the software for the customers you already sold to, or I can't pay you a commission because we have no cash. So stop selling and start fixing the software because we need cash. It's hard to do a business if you don't have cash. All right, so how do accountants look at it? They have what they call net working capital, which is current assets minus current liabilities. It's very similar to ours, except for they include cash and they include short-term debt. And they have a current ratio. So I'll warn you, your finance majors, if you take the fact exam, they have the current ratio on it. I hate the current ratio. I would never use it. I think it tells you nothing about liquidity. And yet the accountants use the current ratio as their measure of liquidity, and you want it to be above 1. Current ratio above 1 is good. That's what they say. I don't believe it. So let's test that. I'm going to show you some of the most liquid firms you can in the market. So one of the most liquid firms I can think of is Dell Computer. Let's get their balance sheet. All right, their current assets, let's look at 2022. Their current assets are 45 billion. Current liabilities of 56 billion. What's their current ratio? Less than 1, illiquid. This is a very liquid company. Now, I've heard some accounting professors say the current ratio is good, but for some firms, it gives you a mixed signal. That's not true at all. I really want to have this debate with the accounting professor. It's not that they're very liquid, but the current ratio just didn't measure it well. No, the very fact that they're liquid is why their current ratio is below 1. It's the liquidity that's causing that ratio to be below 1. Why? What does Dell do so well? When you buy a computer from Dell, they don't build it until you buy it. So they keep, look how small their inventories are. Isn't that amazing? A firm that produces PCs and their inventory is minuscule. That's good for liquidity. It's not that the ratio has some, some noise getting picked up. No, their ratio is below 1 because they are very liquid. They manage that inventory extremely well. And they're actually even making money now. For a while there, they couldn't make any money. They were losing money, which is pretty amazing. I don't know how a firm with $85 billion in revenue loses money. I think I could make money if you pay me $85 billion. But they have finally gotten profitable again. Y'all know where the Dellionaires live? North Austin, Northwest Austin. Yeah, if you go up, you'll see the houses. Pretty big houses. I didn't live up there. All right, so let me show you another firm. Some of you are doing Costco. Costco is an incredibly liquid firm. Current assets, 33 billion. Current liability, well, they're kind of unbalanced, but 28. Yeah, they're more in balance. I'm kind of surprised if I got the right one, but it's close. They're right at 1. But this is an extremely liquid firm, very, very liquid firm. And their ratio's not all good. I guess I should have done Walmart. Walmart's the one I'm going to be showing you. Walmart, 81 billion versus 87, 61 versus 77. Walmart has a current ratio below 1, but an incredibly liquid firm. So now some people say, well, does the current ratio tell you something? Would the trend be important? It's possible the current ratio gives you some insights, but doesn't give you any insights that the net working capital requirement, that word requirement, my ratio, doesn't tell you. My ratio tells you everything. The current ratio sometimes tells you something, but a lot of times gives you false information. So you notice this is net working capital. Mine is net working capital requirement. All right, so don't get them confused. It's very, very similar terms. So if you see this on the fact exam, finance majors, yeah, you want a current ratio that's higher, above 1's good for liquidity. I don't believe any of that. I don't know any people in finance that use the current ratio. The only place I see the current ratio is accountants and academia. But finance majors, finance professionals, current ratios just not used. Questions on this, because this can be an issue. You need to have enough courage to challenge your accounting professor on this. You're probably going to side with them and then badmouth me. But then if you do that, you got to set up the debate so we can have it out. All right. So we want those receivables, inventories. We'd like those to be as low as possible. We'd rather our customers pay us faster. We'd rather have inventory not sitting in the warehouse. So if you're going to look at liquidity, here's a few things you're going to do. We're only going to do a few of these. The first one is the trends and cash from operations. We're going to do that. Cash from operations, if a firm is liquid, cash from operations will generally be growing and growing at a fairly good rate. Trends and a working capital requirement, we're definitely going to look at that. Is that getting better or worse? Use and structure of debt. Are they using too much short-term debt? We're not going to do that one at all. All right, we're going to completely ignore that. Here we're looking at their debt program, how many debt sources they have. We learned this at UTSA after 9/11. After 9/11, UTSA was thinking, well, we borrow money, but a lot of our banks are not in New York City. So we'll be okay. We can go to our Chicago banks. And then they were surprised that a lot of the Chicago banks were completely out of commission. And a couple of New York banks were still working. So you know how banks have to do these contingency planning? They have to test. Well, 9/11, they discovered they weren't ready. So what UTSA did is they set up a debt in Europe. So they added more debt programs overseas. So if something major happened, they could still borrow money from somebody. Backup lines of credit. These are institutions like investment banks, that say, hey, if you can't borrow money on Wall Street, you can borrow money from a bank. That's a backup line. So we're not going to do this, but you can get a lot of this in the footnotes to the financial statements. Does the firm have any liquidity shocks? So maybe you have a customer that's 20% of your revenue and you lose that customer. You know, some of these defense contractors lose the US government. That would be a pretty big problem. Airbus and Boeing, you know, who gets the China business, who gets whatever business, you know, that can be a big deal. That could be a liquidity shock. I don't know Boeing's impact on liquidity of having some of these jets being shut down because of accidents, but that's probably an impact. Litigation, major lawsuits. So the tobacco companies had those big lawsuits, billions and billions of dollars. That's the kind of thing to look at. We're not going to look at that one at all. And then the last one, how free cash flow is deployed. We're going to do that one. So you've got 3 things to look at. The first one's easy. The second one's hard. And the third one's tricky. All right. So those are the 3 we're going to do, but there's others that you can look at. Liquidity is difficult because it's very industry specific and there's not really good ratios to assess it. You really have to delve into it. Unlike other areas where there's some really good ratios that help you look at that. All right, so we'll have to talk free cash flow here. Now I'll get into that a little bit more. All right, so do y'all have your companies ready today? Anyone wants to have it on laptop and they forgot to bring their laptop? We'll wait till Thursday. So try to have your company loaded. If you don't have your data, you definitely want your data by Wednesday. So I think what I'll do is I'm going to show you how this will work and then we'll do liquidity on Wednesday. So let me load my Walmart file, which will look a lot like your Walmart file. I can find it. There it is. So I sent a few of you a file. So you have the Capital IQ. And if that formula is working, it's going to be really slow going because every time you load it, it just takes forever. So those of you I sent the file, I have one that has the Capital IQ formulas, and I have another one that doesn't have formulas. I went to that page that says Capital IQ, I copied and pasted his value. So that's the one I'm going to use. So let's look at this file, just get a little comfortable with it. Load up your company if you have it. How many of you are getting Capital IQ to actually work on a machine? It's about a third of the class. All right. Well, I wish it were a lot higher than that. I do encourage you, accounting, finance, try to get a machine in FSC that works. And I would watch, there's a really good video. I'd highly recommend it. It's probably the best way to learn it. I don't know if I showed y'all a previous class, I can't remember. But you can just do Capital IQ tutorial, and you'll see this guy with the same haircut I have. This guy right here. This right here, in fact, I highly recommend the Corporate Finance Institute. Did I show y'all this earlier? This is an incredible website.
There are still so many financial analysts around the world.
All kinds of free tutorials on Excel, on Capital IQ, all kinds of this wonderful, and very well done. So he has the Capital IQ one. He has several Capital IQ videos.
Welcome to SM.
And they're about the right length, 10 minutes, 15 minutes. They're not like 6-hour videos. And he does a great job of showing you how to use Capital IQ online, which is part of it. It's the internet. You can get a lot of stuff online. And then there's the Excel add-in. He shows you those 2 things. I have not scratched the surface on Capital IQ. I've just been blown away at what it has. One of the things I think is really wonderful, especially for you finance and accounting majors, is when you load Capital IQ. I don't know if you notice, they'll ask you the question, do you want to bring in the templates? Did y'all see that? And at some point you want to say yes, because there are some wonderful templates on Capital IQ. Some that you can probably use in another class. You'll get an assignment. You can just pull in one of the templates, change it to your company's ticker, and you'll have everything you need in like 20 seconds. It's really amazing. So he'll show you how to do those kind of things. But really good, really good stuff. But more than just that, it's this Corporate Finance Institute, a lot of free tutorials out there. All right, so when you bring your firm in, the first page is your company and the competitors. The second page, remember you have to put your company on D5. The third page is print page one. So it's got your company at the top. You have these CAGRs. Here's where you may see some NMFs, not meaningful figures. So if you have a number that was negative, now it's positive, that's where you're going to have that number. One thing you might think about here is you might add another CAGR. The reason I might say that is if 2013 was a really bizarre year, you might not want to do your CAGR off of 2013. You might want to do it off of 2014. So you might want to change that formula. So how would you do that? Well, 2013 to 2022 is 10. So what's my N going to be in the CAGR formula? It's going to be 9. So if you look at the formula, I do if error. Why do I do if error? If it's a negative to positive number, the CAGR is going to give me an error function. So the if error function says, hey, if this formula you're doing right here gives you an error, then do the last thing here. Give me that. Right? So if error is a pretty powerful thing to do. Then I take C4, which is the 2022 number, divided by L4, which is the 13 number, raised to the 1/9 minus 1. If that's less than 100, the reason I'm doing that one is, boy, I think you can go positive to negative. You can't go negative to positive. You go positive to negative. I think it'll show like negative 300% or something. I'm having that as not meaningful figure. All right. It can be negative 50%, negative 10%, but it can't be negative 200%. That's just a bizarre number. So, and there I'm saying, give me NFF. So I have that function in there. So if you wanted to do this from 2014, you would just change L to M and change the 9 to 8. You'd have to do it twice because of the if function, which is not 89. So y'all see how you can have CAGRs from different periods. So if your CAGR is like 80,000% because 2013 their earnings were only $10 million and now it's $47 billion, then yeah, do it from 2014 so you don't have that in there. 2013 is not an unusual year, but if 2020 was our first year, that could be a serious problem for a lot of people.
Oh, no, I would say 2010 to 9.8, but I thought the second one was 3.
The second one was a what?
Your mouth on it, I thought it was a 3, but it was an 8.
8, yeah, it's an 8, yeah. Now there I got an NFF, but I'm not sure why. Oh, I did what? Okay, well, I'll fix that. There we go. All right, so you're not stuck with these CAGRs, but if you do get an NFF, I don't think Walmart has any, but if you do get an NFF, it's going to be because your starting number was a minus, you change signs. And if you do that, yeah, you're going to get an NFF. So just watch that. Now that 2.8%, that CAGR, that's the growth rate if they grew exactly 2.8 every year. That may not be how they grow. They might have been 0, 0, 0, 0, and then they grew 15% all in 1 year. So the CAGR is just giving you that average over time. But so you want to look at the CAGR, but you also want to look at the trend over time. Did it jump or was it fairly stable, fairly steady? All right. The second thing you got to be careful of is this section down on line 34. These are all our turnover ratios. I gave you 4 to choose from. Now, who's doing Lululemon? We got a couple in here, don't we? Okay, so Triana, Lululemon, I would really like to do revenue per store, but you notice they're missing a lot of data. But we can get the data from Statista. So you may have to send me your file again, but I can fix, if you're missing like 1 year, or 3 or 4 years, we can find that data on Statista but you're not going to know where to fix it because it's my complicated spreadsheet. It's really hard to edit somebody else's spreadsheet. So the 3 areas you might have. So square feet. If you have like 9 numbers, you're missing 1, I can fix that. Employees, you have 9 years, you're missing 1, I can fix that. And number of stores. So for Lululemon, I would probably use number of stores. For Walmart, I'm going to use square feet. So it kind of depends. On some firms, and number of employees is what you're going to use. And a lot of times you will be missing 1 year on employees. You just got to bring that in. So if you're missing the one you want to use, if it's one you don't want to use, then just ignore it. We'll just shut it down. But if it's the one you want to use, you're missing 1 number, I can fix that for you. Don't try to fix it yourself. It would take you an hour or 2 or 3 or 4. You're going to be amazed. The spreadsheet it's got so many levels. I can find it really fast, fix it for you, send your file back to you. All right. So when we get to that part, just send me your file. I'll fix it. I'll get it done pretty well. If you send it to me in the morning, I won't get it because I'll be on the bike, but any other time I'll get it pretty quickly. All right. So we're going to be going through all of this and talking about how to use these different numbers. So on liquidity, there's several areas here in liquidity, but right here, lines 29 through 32, that's really going to be our focus, is that working capital. And then I'm going to show you how to use it, how to do more research.
Would you recommend that we start trying to interpret this stuff and writing about it now, or do you want us to wait?
Right now, we're going to cover today and Thursday liquidity, and solvency. So this weekend, I would write the liquidity and solvency section for your firm. And then if you have questions, come back with specific questions. I don't want 30 of y'all sending me your liquidity and solvency. How does this look? Because I can't read that much, but I'm really struggling this one part, or how do I interpret that? Those kind of things, that works pretty well. Since several of y'all are doing the same companies, y'all could get together and compare notes. As long as you write your own paper, you can certainly, in fact, I encourage you to get together and talk about it. That's kind of what you want to be doing. All right. The next page, print page 2, is where all the graphs are. All right. So let me explain this graph here a little bit. So some students get really, really confused. You notice the next sheet says graphs used for Walmart. So what I like to do, let's say I was doing this again. I'm going to add a sheet, and you might say graphs used for Lululemon or whoever you're doing. All right. You put that in there. So what you're going to do with your graphs, you're going to do three things. First, you can get the y-axis the way you want it. Secondly, you're going to look at the competitors and decide if you're going to delete some of those lines. And third, you're going to change the title. So let me do one just so you can see. Let's do times interest earned. All right. So I'm not going to delete it from here. I'm going to copy it. I'm going to put it in the graphs used for. That way, if I mess this graph up, I still have the original one. Okay. And so here I'm going to fix this graph. First of all, the 0.1%, there's some data problem there. So I'm going to take that out. The 0.9, a lot of these graphs, you probably will take the 0.1 and 0.9 out. So if it looks like the median in your company are right on 0, because those other numbers are so far off, just take those out. You see how easy that was to take out? Now, if you need them back, what do? You still got the original chart. All right. The other thing I'm going to see is I don't like a lot of white space. So this one, it might not be so bad, but if I want to edit it, I might start this at, say, 10. This one, not so much, but I might do that. All right, just so I can see it. It just depends. If you really can't tell if the line's going up or going down, change the axis. I remember at USA, I just thought it was so funny. Our real estate company, they wanted to show that this number really hadn't changed much. So here was the graph they sent us. You say, see, it really hasn't changed much. Okay, no, you need to change your y-axis a little bit because that's not right. So what I've done on the print page 2 is I put this back to auto, whatever Bill Gates thinks is the right axis. So you can change that axis. So change the axis, get rid of the 0.1 and 0.9. You might sometimes get rid of the 0.1, but not the 0.9. It kind of depends. Everyone's gonna be a little different. And then the last thing is the title. Strong, whatever, ability to handle debt. So what you do with titles, this is very, very important in finance and accounting, probably in other fields as well. The first thing on the chart should say why the chart is there. What story are you telling with the chart? Are they improving? You could say great recovery since COVID, are back in line with the industry on debt. And then the second line tells you what the ratio is. All right. So your first line, what is the chart telling you in a summary? Second line, you can mess around with the fonts. Try not to have a paragraph there, try to make it reasonable. If you have too many words, you can put a text box with an arrow if you're trying to point out, hey, why they really jump because of COVID or whatever. You could certainly do that. All right. So those are the three things you do: the axis, the 0.1 and 0.9, and then the titles. And if I really mess this up, what do? Delete, copy it again, and just start all over. All right. So you probably are just going to delete the graphs used for Walmart and create your own. All right. Does everybody understand that? Because I'll have at least 5 in here are gonna have that issue. And one thing I have is students will go into the graphs used for Walmart and they'll look at it and say that doesn't work, and that's because the axis is set up for Walmart. And I say, what do I do? Well, you just click on the axis and you reset. But the print page 2 already has done that. So start with print page 2 and create your own. Any comments, questions? Y'all got that? Right? So you notice that the graphs go in the order of the paper. So remember, liquidity had 3 things. There they are: 1, 2, 3, and then a 4th one. There's liquidity. And then you have solvency: 1, 2. Then we have the overall summary on short term. There he is, 1 chart, 2 charts. Then we have turnover. All right, so it goes in the order. It's not like on the exam when they give you charts all out of order and you got to figure out which one goes where. So it's pretty obvious. The first 4 charts are going to be liquidity. The next 2 charts are going to be solvency. So I'm not making you have to try to figure out what category they go into. All right, so are y'all going to be ready for Thursday? If anyone doesn't have their data, so we're gonna go step by step. You could almost write your paper in class where we're going, or at least get it set up. So one thing I recommend you do, start with the Walmart word. Everybody understand that? You bring up the Walmart word, and then delete all the Walmart charts. And I would copy your charts in without the titles readjusted yet, just so you have the charts in your paper so you can talk about them. And then as we go through it, we'll talk about it. And then if you see something unusual in your chart, we can bring your company up and talk about it. All right. So Thursday, we should be able to finish liquidity, hopefully, maybe solvency. I don't know. It kind of depends. All right. No questions? Everybody's good? All right. So important day today. We're going to walk through Walmart. So this weekend, you want to definitely get liquidity drafted for your company. The hardest part of the paper, so that's nice. You get the hardest part out of the way first. And then we get into solvency. You might also do solvency. Solvency is the easiest part of the paper. If you remember our rubric, you always want to keep that in mind. So what we want to do on liquidity, a real simple one, is just look at their cash from operations. Is that growing or not? The CFO is not a perfect measure of liquidity, but it's pretty good. It's better than net income. And then we'll spend some time here on net working capital requirement, because that's a tough one. And we'll have to spend a little time on this one too, on the financing, because that can be a little tough. So you got 2 kind of tough ones in here. And so when we look at Walmart, you have an introduction, just says what you're going to do in the paper. You can essentially, one thing you might want to do when you start is do a search and replace on the word Walmart. I always have at least a few students that have Walmart in there at least a couple of times. So just search and replace, get rid of Walmart. So introduction can be the same for all of you. So, some of y'all probably don't feel comfortable loading this Word file and editing it, but that's what you're supposed to do. You don't have to start from scratch. So the first thing we're going to look at is liquidity. And you'll notice this format. I would, if I were you as a college student, go to this format when you write your papers. 2 columns, an abstract at the top, very narrow margins, single space. Don't write any more double space papers for the rest of your life. All right, they just look so unprofessional. They look like a college paper. You don't want any of your paper. You need something to put on LinkedIn. You could actually put this project on LinkedIn. It looks pretty good, even though you're kind of using my format. That's fine. But yeah, make it look as professional as possible. The model is the Financial Analyst Journal. What did their articles look like? So you want to look as professional as possible. All right, so the first thing we're going to do look at is liquidity, and we're looking at 3 things. So real simple. So when you do a chart, remember you have the chart in there. The title of the chart tells you what the chart is telling you, and then this your paper has the chart in it with bolded, and the reason you do that is your boss sees the chart and then she wants to know, well, where do you talk about the chart? Then they can easily find, oh, chart 1. So what you don't want is they see the chart and then they're looking through all your papers, see, where'd you talk about chart 1? So you want it somewhere close. So these are just things that just make it look a lot more professional. So all we're going to do here is look at their cash from operations. Here's where the CAGR comes in. So if you remember from the Excel file, we have a CAGR. So cash from operations is this line 12, and there's your CAGR. Usually CFO is a positive number, but if you go from a positive, any job at NMF on your CFO, you won't be able to use the CAGR. Now I have some students say, I can't do, they put in a paper, I can't do CAGR because it's not meaning, don't put that in there. You don't even mention it. So if it goes from a negative to positive number, what you have to do then is you just talk about the shape of it. They struggled in 2013. Their net cash flow from operations was actually negative, but since then it's been consistent, something like that. We're just describing. So there's 2 things to do here. One is give the CAGR if you can, because we think in terms of CAGR. 2.42 doesn't sound like a particularly strong number. And the next thing is you might talk about what's going on in the shape. So it went from it grew 2% from here to here, but you definitely see the COVID impact on Walmart. And so I mentioned that in my title. All right. So I can't tell you exactly what to say. It depends what your chart looks like, but everybody get the process here. Bring your charts in. You might have trouble bringing the chart in. So let me show you how I bring charts in. You might have your own way to do it. Y'all remember how I said graphs for Walmart? You're going to create your own for that. Everybody understood that? So what I do is I take the chart and copy it. And then my preferred is to paste it as a bitmap. I don't know what, does anybody have a preference other than bitmap? If you do the Microsoft Excel option, you might say, well, that's really, really good. That object is really good because then we'll change something in the spreadsheet, it updates it. The problem with that is when you bring it in as an Excel object, it changes colors, it changes axis, it just does a bitmap. Is like pasting it as a picture. And so you get exactly what it looks like, all right? So I recommend you paste it as a bitmap. I've seen students paste it as an object, and I've set up the color so they're consistent throughout, but if you do the object, it keeps changing the colors, it changes the axis, everything's really messed up. So I would paste it as a bitmap. You don't have to do bitmap. You're perfectly free. If you want to, you can do a snip and just copy and paste it. But the bitmap works really, really well. It gives you get exactly what that looks like, which is really, really nice. So if you read this, Walmart's CFO had been growing at a very subdued pace until the jump in 2020. That was a temporary jump, and the longer-term trend continues to be flat. CFO's compound growth rate. So you got to put a word in there. I used weak. See if you can come up with other words besides weak. I like weak, anemic. What else could you have for a low number? Pathetic, uninspiring. You got to think about what words you're going to use. So get the thesaurus out and start looking. Any of y'all have like Lululemon? Anybody, what's their growth rate? Pretty high growth rate, isn't it? Can't remember Lululemon, but I think I have it in here. Nope, don't have it in here. Well, Netflix, let's look at Netflix. Netflix should, all right, Netflix, Evelyn, is probably one where you may have a change in sign. So each of y'all is going to have something difficult to talk about. For Netflix, the CFO is actually a little bit of a mess. I don't quite understand what Netflix is doing, but it has to do with that production, which is really important to them, right? They stopped just buying other people's stuff and they've started creating their own. So look at this number for Netflix, 97% growth rate. Does that sound like a strong growth rate? So it's probably distorted, and it's probably distorted because probably the beginning number is really, really small, and it was. So that growth rate is a nonsensical number because it was just barely positive in that year. So here's where a case where you're going to definitely be, look, I mean, just look at his strength. So who else is doing Netflix? Anybody else? Everyone's the only one. I would have brought up Lululemon. I think Lululemon's got like an 8-9% growth or something. What was their CFO? I think it's in the 8 to 9% range. I remember. So Evelyn, you'd probably say, you know, this is them doing the production. And I don't quite understand why they put that in CFO, but it doesn't go through net income. So they have negative CFO but positive net income. That's a little bizarre. But I do think it's that production. And then somehow it's no longer an issue. So I don't know how to explain that. You might have to just put more research as needed. But I do know it's related to their producing their own shows. All right, Triana, did you find theirs? All right. So if you catch it. So anybody else have an unusual chart there? CFO is usually pretty stable.
Ferrari is 10.31%.
That's a strong number. Yeah, definitely strong. And, you know, look at the trend too. You know, if anything happened, you know, 2020 COVID, who knows? That might have helped Ferrari. People are like bored, went out and bought a Ferrari, but you know,
Actually, like, they went down in 2020.
20, yeah, you would kind of think auto dealers kind of suffered in that year.
And you said for the axis, we could be like changing it just
Yeah.
to like illustrate more the.
Don't change it on print page 2, but change it on the
graph.
when you copy it and paste it over. Yeah. All right. So yeah, so Netflix has a challenge there. That should be the easiest one, but for them, that's a little bit of a challenge. You can put that growth rate in there. I don't know what word you use, but it's not that they have phenomenal growth. It's that your starting number was distorted because of all this production. And so it's not really a comparable number. It's hard to explain. You would take quite a bit of research. I don't understand it. I've tried to figure out what Netflix is doing. There's some strange accounting going on.
Like creative again.
Well, I don't know if it's creative. It's
We can use like the axis from print page 2, right?
you can, or you can edit it. Print page 2 just is whatever Bill Gates used.
Okay.
There's no changing, but if you change it, yeah, you can change it. It's up to you. My goal is to get rid of as much white space as possible. So did I tell you my real estate story?
Hmm.
So our real estate company came in with a chart.
Oh yeah.
Did I told y'all that? Yeah, I mean, it's like, so you want to get rid of all this white space so you can see what the actual trend is. You can't just have a straight line. So, you know, you got to look. You got to be careful when you do that. You may get a really wild line, but it's between like 1% and 1.5%. So you kind of look at it and say, you can see the trend. So if the trend's grossly misstated because it really is pretty immaterial, but it just happens to be really stable. I mean, a good example of that, we can look at Costco's net margin. Yeah, you don't want to exaggerate it. So you have to, you know, this is the critical thinking part, you know, use your judgment. Any questions on CFO growth? So what's a good growth? What's a weak growth? You know, think of inflation. I know inflation's been high recently, but over the long term, 2 to 3% inflation, you would think any of these numbers should just keep up with inflation. They should at least do that. So you would expect just a 2 to 3% growth just if they weren't trying at all. 5 to 10 is pretty strong. Above 10, there's something obviously strong going on with the company. Fast growing pretty well. Negative numbers are almost never good. With a negative number, be careful. Again, a CAGR only looks at two numbers, the first number and the last number. So it's possible there's something unusual about the first number, there's something unusual about the last number. So you have to look and see, wow, you know, this CAGR really doesn't tell me much because they had something unusual happen in one of those 2 years. And that's why I said you can do your CAGR from a different year if you want to change the formula. All right, the second thing is working capital. This one's tough. Here's this paragraph you got to be really careful on. So when we look at Walmart, on print page 1, the net working capital requirement is lines 29 through 32. So here's where students mess up on their paper and on the exam. So if net working capital requirement is a negative number, working capital is what? A source or a use? Get a negative number.
It's
It's a source.
source.
All right. Why? Because those working capital assets are cash destroyers, inventory, receivables, and the working capital liabilities, accounts payable, they save us cash. Remember the unearned revenue for United Airlines? That's a wonderful source of cash. So a negative number is a source of cash, but real careful. By negative number, I mean the dollars. This negative 12,400, y'all see that? Don't look at the CAGR. It has nothing to do with the CAGR. So some students see that CAGR is positive 12%. Oh, so it must be a use of cash. That's completely wrong. All right. It's not the CAGR, it's the dollars. Okay, so let's test with Netflix since we got Netflix up here. Is their working capital a source or a use of cash? Source, right? The growth is positive, that's good, but the cash flow is negative, so it's a source of cash. All right, so let's think through this. A source of cash is great. If it's a source of cash and that's great, do you want a high growth rate or a low growth rate? High, I want a high growth rate. What if it's a use of cash? Would you want a high growth rate or a low growth? You want a low growth rate, all right? So you got to look and see. So for them, it used to be 271. Now it's 472. It's growing pretty well. That's good. So that looks good for them. So you have to kind of look and see if it's a source or use. So for Walmart, look at this sentence. Looking at the net working capital requirement, we see that working capital assets are less than working capital liabilities, which means the net working capital requirement is a source of cash. The normal situation is for it to be a use of cash. So what we're saying here is Walmart is spectacularly good at liquidity. They have a very, very liquid operating cycle because their working capital is a source of cash. All right. Let's rewrite this. I don't have a use of cash company. Let's see if I can find one here. It takes so long. I'll try Dolby. I love Dolby, interesting company. Any of y'all probably buy Dolby products and don't know it. Probably your car stereo or somewhere, maybe your PC, laptop's sound system. So there are a lot of places. All right, sorry, it takes so long to load everything. Yeah. I don't know when Bill Gates decided to do this enable. It's like, you know, it takes 3 minutes to load a file. Oh no, I can make it 6 minutes. It's like, oh, thanks, Bill. Appreciate the help. All right, so this is a good one here. So Dolby, is their working capital a source or a use of cash? It's a use. No CAGR. Why don't they have a CAGR? Because it used to be a source. So how does that sound for liquidity? Pretty negative, right? That's not good. Used to be a source, now it's a use. So the question is, why did that change? And that's what we're going to work on here next. How do you get the answer? You notice anything growing unusually fast in their working capital? Their assets. So it looks like the assets is the problem, all right? So we'll have to figure out which asset is it that's causing that, all right? And I'll show y'all how to do that. But let's do it since we're here. So what I did at the bottom of the page, lines 54 through 40, 59, I gave you the pieces of working capital. And you notice for Dolby, it's both the receivables and the inventory is growing. But look, this is a really good example. I'm glad. Who's doing Dolby? Someone must. Okay, Jacob. This is a good example. So he can write his whole paper right here. So you notice they're both growing fast, but which one's probably more important? Just look at the numbers.
Accounts receivable.
Accounts receivable, no questions. So there's something going on with accounts receivable. Do you notice any particular year that may be an issue?
2016.
2016, 2017. All right, so Jacob, you don't have to research this. You could in your paper say something unusual happened to receivables in 2017. That's why it went from a source to a use. More research is needed. He could stop there. What else could he do if he wanted to? I'm not saying you'll have to do this. He could go to their 2017 annual report, and there's going to be a footnote explaining why accounts receivable jumped so much. Anytime you have a big jump like that, they have to explain it, and you could do that. So I just love this is a big advantage. I can't say in Kappa IQ because I'm not logged in, but in Kappa IQ, he could load Kappa IQ on the internet, not on Excel. He could find 2007's accounts receivable. He could actually click on it, and it would take you to the annual report and to the footnote. I mean, Kappa IQ is incredible. But I'm going to do Dolby annual report 2017. Let's see if it will come up. See if we can find 2017. Archive. There we go. Submit. Oh, they're going to make us email them to get it. There it is. All right. So how do you do this type of research? So we have accounting majors, finance majors in here. You got to learn how to do this. It's forensic kind of work, right? You got to drill down, drill down, drill down. So the way I would do it is I would start with the balance sheet. Financial statements really close to the end. So I would find a balance sheet. I'm not finding it here. So see, I might do a search. Let's see. I'm doing this, on the fly. So yeah, there's 55 times word balance sheet comes up. Hopefully I'll find it. All right, there we go. Balance sheet. All right. So what I want to do is see if I can figure out which account did that. All right. Inventories, there's accounts receivable. So I pulled up 2017, but this might actually be 2018. That looks like 2016, doesn't it? You're showing 74?
Yeah.
Right? So that's the other issue you have with years, and it's very frustrating. Between Bloomberg and Kappa IQ, Dolby says this is 2017. Kappa IQ says it's their 2008, or says this is their 2016. It gets really confusing. Walmart's fiscal year is like February through January. If you did February through January, I would consider, if it's February 2022, I would consider that to be 2022. Bloomberg considers that 2023, even though you only have 1 month in 23. Isn't that irritating? And so what do we have to do? We have to go back and now do 2018. And now I got to do a search on balance sheet again. What page was it here? No, it's pretty clear, close to the top. So 14, let's try 14. All right, does it show up here? You'll see it now. It shows up. Now, why do I find it there? Because I want to know the exact account name. And they do call it accounts receivable, but they may not. It might be trade receivables. It might be customer due or whatever. So now you can actually do a search on the word accounts receivable, and you're going to look for that discussion. All right. So you can see how it's, I just kind of and type it exactly how they have it. Accounts receivable. It's in there 11 times, so that's not bad. Changes in operating assets there, you can see a little bit of discussion there in the cash flow statement. There's something there, but I'm not gonna go through the whole thing. Y'all see the process. I'm not asking y'all to do that, but that's what you would do. Now, if you're an accounting or finance major, if you're like I am, say, well, I don't have time to do it, but I gotta do it. I gotta know. You're kind of just like, I can't leave until I know the answer to that. It's just kind of the nature. That's what I did with Walmart when they had their thing, and then it ended up being a big waste of time because they were using a lot of terms that really weren't helping me. So that's what you're doing. You're just gonna keep searching. There hopefully will be a footnote explaining it. That's what I found with Walmart. I'm not seeing it here, but with Walmart, I found a really long footnote. So they explained what I was looking for. They just didn't write it in English, so I couldn't really tell what they were doing. Kind of frustrating, but that's every firm has their complicated things. So, all right. So y'all see if it's a source or use.
So then when we're doing like the source and we're like explaining like when's the big jump, like or like a jump like from 172 to 258 be like.
Well, it depends on your numbers. You look at it and just see if they went from 1.2 billion to 1.3 billion, probably wouldn't matter. If they went from 50 million to 200 million, then yeah, it probably matters. So you, like everything's perspective. Numbers that are big for Dolby aren't big for Walmart. So it all depends. This is kind of the critical thinking. You've got to decide. There's no obvious answers. Every firm is different. It's a unique situation. Y'all see why I don't do case studies. Case studies clean all this up and make the world look a lot easier than it really is. The world's pretty messy. That's part of my goal. In this project, you can see in real life, the numbers are messy. You got to deal with that. It's just part of the financials. It's not a problem with accounting. It's not the accountants are messing up. It's that these businesses are quite complex. They do complex things. It's really hard to get everything perfectly lined up like that. Now, what could Dolby be doing? I'm not sure, but I know digital licensing is a big, big thing. So I know Adobe, not Dolby. Y'all know Adobe. Adobe went from mailing out CDs to having an online subscription. Could they have a big impact on your accounts receivable? Yeah, that certainly could. Now, did Adobe do that? I don't know. So there's things like that. You go, wow, the world is really dramatically. When Adobe switched from mailing people CDs where they made like $50 to instead not mailing CDs and instead have like a monthly subscription of $10, people are like, how's this going to impact your finances? Their financial statements. So that's what you're looking at. All right. Any questions on something being a source or a use? So make sure you're looking at the dollars. Don't look at the percent. The percent tells you how much it's growing. If it's a source, higher growth is good. If it's a use, lower growth is good. Those are the kind of things you're looking for. And if you're trying to figure out why it moved materially, you have some details down here that can help. If you have a bunch that are moving a bunch, then focus on the ones that are the biggest dollars, because that's going to be the biggest impact. All right. You know, kind of getting this.
What if my data has the opposite? So instead of being a source and then using it, was using it.
That'd be great.
Okay.
Again, you want to see what happened in that case. It's something unusual, change. If it all change, like with Jacob, it all happened in 1 year. So he can see it went from a source to a use in 2017. So then he can just really focus on those 2 years, because it didn't change that dramatically after that. And then there you can see, wow, it's all right there. It's receivables, which is a pretty good. He's gotten pretty far. I mean, if he were in an interview with this company, says, yeah, you guys are a lot more liquid now. You have your working capitals as a cash outflow, but wow, if something happened to receivables in 2007, they'd be pretty impressed with that insight. It's like, I don't know what it was. I was trying to find it in your report. That would be far better than 99.9% of undergraduate students. So this is the hardest part. So once you decide first whether it's a source or use, then you're going to talk about the trend. So chart 2, what I do on the trend is I take net working capital, but I do it as a percentage of revenue. I used to do it as a percentage of CFO, but now it's revenue. And so what do you want this line doing? Do you want it going up or going down? More liquid would be what? Going down, yeah, the further down. So if it's a positive number, but less positive, that's good. If it's a negative number and it's more negative, that's good. If it's a positive number and it's going up, that's bad. If it's a negative number and it's going up, even though it's still negative, that would be weakening or liquidity. All right. And you would expect the trend to essentially be flat line because I'm dividing by revenue. So even with inflation, revenue goes up with inflation. So a flat line would be what you'd expect. You would expect their working capital to move with their revenues and it'd just be a flat percentage. So the fact that Walmart's getting a little bit better, right? They went from 1% to 2%. That's a pretty significant improvement. Was there any particular year where they're getting better through 2017? COVID seemed to cause some noise. This is that big transaction that messed me up. But they've been fairly flat since 2016, but great improvement since 2013. That's where I could go to that bottom part here and try to see if there was something going on. So for Walmart, it's going to be inventory and accounts receivable because for them, that's the bulk of it. So I'd look in those two and see if anything unusual happened during those years, try to find something that's sticking out. But Walmart wasn't that dramatic.
So, now I said to compare the accounts payable. So like, what if it's like just slight little drop downs? Like, would you say that's like a good thing or like or bad? Like if it's not
Yeah.
like a super big number.
Yeah, I think it's Disney. Is someone doing Disney?
Yes.
Yeah, so Disney's like that where their line's like right on the line and this is kind of bouncing around. Well, I would say that it's pretty material, which is a good thing. So for Disney, if I'm right about Disney, I would say it's not a really material issue for them. They've somehow managed their working capital assets and liabilities, so they're always in balance. It's not a source, it's not a use, it's just something that they've kind of taken off the table. So yeah, working capital is not a big deal for this company. They've somehow managed to stabilize it. So there are a few companies like that. They could have massive working capital assets, massive working capital liabilities, but they somehow keep them about the same. So the fact that it goes from negative 1 million to positive 1 million for a multi-billion-dollar company, it's essentially just zero. And you just say it's just a non-issue for them. Yeah, good questions. All right, so here you'll just have to decide on your firm, but you kind of see on working capital requirement, is it a source or is it a use? What's the trend? And is there anything unusual in the year to year? Did you have any jumps, anything unusual? That's what you're looking for. You're going to try to explain it using the bottom of that page 1. I'm not asking you to go do more research. If you want to, I'd be ecstatic. I definitely would, give you some brownie points for that. You don't have to do that. You can see it can get really time consuming to try to track down why did that change. What would you do if this was your career? You're a security analyst working for JP Morgan. What would you do? You must spend the entire week on that one question. So it's that important. Because especially sell side, if Luke or Carson works investment banking or Sebastian investment banking, JP Morgan, I forget who our other finance majors are, so sorry. But they're on the sell side. The sell side gets like 10 companies. Can you imagine spending an entire year, 50, 60 hours a week on 10 companies doing exactly what we're doing here? How well would you know a company after a year? You better know it really, really well, right? Because your customers are going to be calling you and say, hey, what happened? You're going to know it off the top of your head exactly what happened. So yeah, that would be your career. So if you're not enjoying researching your firm, you probably don't want to be an analyst because this is what they do all day long. It's like forensic accountants, forensic finance people. They're trying to answer, why did this thing jump up like this and then jump back down? What's going on? What are they doing? All right, and then you try to explain which accounts payable, accounts inventory work.
What website do you do that's to go with that?
We'll go through the annual report. So Capital IQ is ideal. I just can't show you because I'm not logged in. Maybe I'll try on next Tuesday to do. But yeah, I'm amazed at Bloomberg doesn't do this well, but Capital IQ, not in Excel, but they may in Excel. I can't remember. But yeah, the ability just to click on the cell and it takes you to the footnote. A lot faster than what I just did, right? Having to do searches and all that. So that doesn't mean it's going to answer it because sometimes the footnote is just gibberish that doesn't mean anything to anyone except for the people in the firm. So who writes the annual report? What profession? Probably the accountants. At USAA was the account. I wrote the investment section. Well, I was responsible for the investment section, but the accountants are writing most of this. So even though it's finance is maybe explaining a lot of this, the accountants have to understand it and really do it. Yeah, I remember I was responsible for the investment section of USA's annual report. And the CEO found an error and he was irate. He comes to me, "You were responsible for this." It's like, I'm about to get fired. And I looked at the number and said, that's not the number I approved. That's the wrong number. And he's like, okay, someone's going to lose their job. Well, they discovered it was the CEO in a meeting that changed the number without checking with anyone. Because he was on, guess how quickly they fired him? Not at all. He kept his job. I would have been fired, but he didn't. So yeah, it's in a massive process to do these annual reports. It really is, takes weeks, and it's the many accountants are doing it. So the data's in there. GAAP accounting requires them to explain any major changes. So if you see a major change, there's got to be something in your annual report that's explaining that. Whether you can understand it and figure it out, who knows? Because these firms get really complicated. All right, so source or use, what's the trend? And then if you can somehow figure out why there was any bumps or jumps, looking at payables, inventory, that's the last part. All right, so this weekend, do your best to get that net working capital requirement drafted. That would be a good one to catch me in office hours after you draft it, and we can work on it together to make sure you have that part down, because it can be the toughest part. Any other comments, questions on your companies? Anyone seen something bizarre in their company? All right, so let's jump to free cash flow. So in the class notes, we talked about this, but it's been a few classes. We talked about we want free cash flow. That's what finance says. Finance loves free cash flow. A few finance majors, if you take Cat Packham's class, he'll go into it in detail. So finance says we want to produce free cash flow. Remember, free cash flow is the firm's producing cash that management can do with that cash whatever they want to. It's not, they don't have to put it into buildings to fix buildings up. It's free cash flow. It's hard to measure free cash flow. There are formulas for it, but you can tell when it's there. Why? Because firms producing free cash flow will be paying dividends, are buying their stock back, are paying down debt, are doing capital expenditures. You'll see those type of things. I didn't put number 4 on in your paper. And so when we get to Walmart, I gave you this chart. It's a little bit of a confusing chart. So chart 3, let's look at it. So if it's above the line, that's a cash outflow. So it's kind of strange. All right. Above the line is an cash outflow. Why? Because they're trying to assess free cash flow. The firm's producing free cash flow. It's sending cash out the door because it has so much cash. If it's below the line, that means it's a cash inflow because they must have been short cash, or they had to go get cash from somebody else. All right. So make sure you understand above means they're paying money. And so just with that understanding, did Walmart borrow any significant cash in any given year? 2018, that's borrowed money. All right. Most years they were paying back their debt. Here's their dividends. You notice their dividends are pretty stable. You want to look at their dividends in detail. You can go into Yahoo Finance and bring up your firm and click on historical data. And you can just do dividends. So how predictable are Walmart's dividends? Y'all tell me here. Let's see. They paid 57 cents a quarter, 56 cents a quarter, 55 cents a quarter, 54 cents a quarter, 53, 52, 51. Anybody want to guess previous year?
Yeah.
50 next year. Pretty consistent. All right. And you see that a lot of firms, very consistent dividends. Now we do Costco. So $1.02, 90 cents, 79 cents, $15. My word, pretty unusual. So every few years, they do a massive dividend. But who, I know some of you are doing Costco in here, I forget. So yeah, you're not going to see that in that report because I'm pretty sure that $7, that massive dividend they did here, I think it's getting reclassified as a stock buyback, not as a dividend, because you're not seeing it in the dividend line. You're seeing it by, I don't know why they reclassify it. That really is more like a stock repurchase than it is a dividend. I'm not sure why they do that. It's kind of strange the way it's predictable that they're going to do it every few years. They don't do it exactly the same number, and it's not like every 5 years, but you see a massive dividend with them every once in a while. This last one looks like it's probably the biggest one they've ever done, $15. That's pretty sizable, $15 dividend. It's a $700 stock, but still $15. That's a sizable dividend. When they normally do $1, that's pretty massive. I don't have Costco to bring up here, but so the stock buybacks for Walmart, you notice they're much more lumpy. And that's you're going to notice that dividends, with the exception of Costco, dividends tend to be real stable. Firms don't like to go all over the place on dividends. Stock buybacks are going to probably be pretty volatile. You may have some firms that have a stock buyback and then they issue stock. You get the red line below and then they buy back. All right, so some of your firms are going to find this, and this is really intriguing, where they borrow money and they buy stock back. And there has been a lot of that going on the last several years where firms are actually borrowing money to buy their stock back. That's not a free cash flow. A free cash flow is you're producing a lot of cash and you buy your stocks back. If you had to borrow money to buy your stock back, you obviously weren't producing free cash flow. That firm is essentially recapitalizing itself. It's shifting out of equity into debt, and we'll talk about that later. So a few of you firms are going to definitely see that. That's especially the tech firms have been doing that quite a bit. People argue they were doing it because interest rates were so low, so they're borrowing cheap and buying their stock back. I'm not sure that works from a financial theory standpoint. So we can see with Walmart, very stable dividends, stock buybacks that are lumpy but look pretty solid, at least the last few years. One large borrowing. Now, if you see something like this, more than likely they acquired another firm. So how would I figure that out is, well, you could go to Bloomberg. Bloomberg has a really good mergers and acquisitions function. You could look it up on Bloomberg. What I did is I did Walmart acquisitions 2018, 2010, and it just comes up on the internet. So 2018 is when they purchased Flipkart, and that's what they borrowed the money for. So I found it. If you can't find it, you don't have to spend hours looking for it, but most likely one large debt issuance is usually a stock, either they acquired another firm or they did an unusual stock buyback for some reason. Check it.
Oh, yeah, what instance would you see dividends jump significantly?
I don't know. Is that happening for your firm?
No, it's pretty stable, but if it does.
Well, you saw Costco's. Costco really is the weird one. You'll see a firm like Apple that wasn't paying dividends and suddenly starts paying dividends, but their dividends are so pathetic. I don't even know why they do them. I've seen $100 stocks that'll pay a 1 penny dividend. And you're like, why are you even bothering? Yeah, it's not usual because Walmart likes really stable dividends, so it's unusual to do it. So I don't know if, and then y'all see a firm other than Costco that sees that kind of jump. And I don't think you're seeing it on the dividend line, are you? You don't see their dividend in chart 3 suddenly get massive, right? It's just pretty stable. So they just don't show it. I can't see that far, but yeah, they just don't show it. If you're on Zoom, you could share it, but yeah, so that's just not too usual. If you see it, you'd probably want to research it. If they're going from like 20-cent dividend to $1 dividend back to 30-cent, that is really frowned on by Wall Street. So it's pretty unlikely they would do that. Huh? Did it jump or was just a little bit up? It's, I'm not real sure why they count that $15 dividend. It's strange. So let's see if they did jump in 2020 on just the dollar itself. Yeah, you don't see it here. They did pay a $10 dividend in 2020, but I haven't seen it, so there seems to be some confusion of what to do with that dividend. So you'll just have to kind of, write up that there is something unusual going on. So the question is, does Walmart look like it's producing free cash flow? In 2022 and 2021, they sent out $20 billion to stockholders and bondholders. That sounds like a liquid company. You're not going to mail out $20 billion in cash if you're having liquidity problems. So this firm must have great confidence in their liquidity because they sent $20 billion out the door. Yeah, they did borrow a little money in 2022. Who knows what that was for? But it's not massive. So essentially what you're looking here, if you have strong positive numbers, they must be producing free cash flows. If you don't see that, if a firm is borrowing a lot of money, so Evelyn, Netflix was borrowing quite a bit of money there for a while. Yeah, I don't know if you see it in your numbers, but there were some pretty significant borrowings because they were doing all this production. In fact, boy, Netflix is an interesting company. I don't know what their credit ratings are today. Yeah, they've been upgraded. But there was a time where the stock market loved Netflix and the bond market hated them. They were a junk bond, double B bond, but the stock market loved them. And it's because they were borrowing so much money for this production. It looks like they fixed that and they've come out of that, so that hopefully will reflected in Evelyn's numbers, and she'll see that there. So Walmart, I'm going to give them a strong that there's strong evidence they're producing free cash flows because they're sending so much cash to their stockholders. And I have this word here, confidence. If you see them sending a lot of money out to stockholders and bondholders, they must have great confidence in their liquidity because you wouldn't do that otherwise. But the question is, are they really producing free cash flow, or have they just run out of ideas and they've stopped reinvesting in the firm and they're just sending that cash out? So that's where your CapEx comes in, chart 4. They have been decreasing CapEx up till 2020, and then they suddenly started increasing it again. So there is some indication that maybe some of that cash they've been sending out is because they're not building as many stores, they're not expanding as much, but then the last 3 years they have. So this looks really strong for Walmart. They sent $40 billion to stockholders and bondholders while they also increased CapEx. That's the firm that must be producing a lot of free cash flow. And I do think Walmart, you know, I don't know if you were paying attention to Walmart and Amazon about 5 years ago, but the story was Walmart's old news, they're going out of business, Amazon's taking over the world. That's entirely flipped. Walmart has now figured it out, and Amazon's one that's struggling. And what did Walmart figure out? They figured out they got a lot more stores than anybody else. They're with what, 10 minutes within 90-something% of all Americans. So what are people doing? I've noticed more and more of my students doing this, ordering online from Walmart and picking it up from a store. Any of y'all done that yet? That's really tough for Amazon to do, isn't it? They bought Whole Foods, but not 90% of Americans are not within 10 minutes of a Whole Foods. I don't know where my nearest Whole Foods is. I think there's one on I-10 here somewhere. I think I've shopped in Whole Foods once in my life, and Trader Joe's once in my life. They're just too fancy for me. But there's a lot more Walmarts pretty close. You can get stuff there. So Walmart has said, our advantage is our locations, and we're going to take advantage of that. You know, if you order for Amazon, it's possible you can get it same day. I've been amazed at getting same day delivery, but still it's not in the next 30 minutes. It's going to be, 5 hours later. If you need something now, you don't want to go in shopping, you don't want to change, you want to stay in the sweatpants or whatever. Yeah, you can order from Walmart, drop by, pick it up on your way to work or whatever, and you don't have to go in, you don't have to go through the checkout line. I don't know how fast they are. I've never tried it myself. If you drive up, and I think Home Depot and Lowe's and other places, I did do that with Home Depot once, and it was sitting there waiting for me, but it took a lot longer than I was wanting it to. So Walmart has done actually, I think, a really good job of reinventing themselves and really competing with Amazon. I think Amazon's actually struggling quite mightily because they're just not very profitable. We think of Amazon being very profitable, but their retail side is not. It's their AWS and their cloud services. That's where they make their money. I know they're doing new stuff with advertising and stuff, so that could help them. But I would get Walmart really high scores on free cash flow. They're spending a lot of cash. They don't have to. It's a free cash flow. They don't have to do more CapEx. They don't have to buy stock back, but they're doing it because they're producing so much cash. All right, so questions on that? Again, I'm doing things as a percentage of revenue. Mainly because CFO has a lot of noise. Revenue tends to be a little more stable, so it gives you a little bit better picture. What was happening before, when I was doing CFO, I wasn't sure if this line was going up because they're doing more CapEx or because their CFO was falling. Now I'm pretty sure they're doing more CapEx because I'm doing it to revenue, so that helps clear up this picture a little bit better. All right, so we got through liquidity. Questions on liquidity? Y'all feel overwhelmed or you feel you got it? If you feel you got it, you're in great shape because this is the hardest part. The scale of 1 to 10,
So
7, that's pretty good. If you're a 7, you're in pretty good shape. It was your first time to see this. So liquidity is always the hardest. It really is a tough thing to assess. All right, let's jump over the solvency. Back to the class notes. Solvency, pretty straightforward. Most students get 100% on solvency. All right, so on solvency, there's 2 things we want to look at with solvency. We want to look at their ability to repay their debt, and we want to look and see how much debt they have, if they have too much or too little. Those 2 are somewhat related, but the first one is called times interest earned. We're going to use IBIT for the first time, so do y'all know what IBIT is?
expensive or before.
Before is correct.
Earning before.
Earning before
Earning.
interest and taxes. All right, I've heard students say earnings before income tax. That's not right. It's earning before interest and taxes. What about EBITDA?
Depreciation and
Depreciation. And what about EBITDA? I'll let y'all look that one up. That's a real estate one. All right, so there's several of them, but EBIT and EBITDA are the most popular. Dr. Demandaran at New York Stern School, he says we like EBITDA because we like saying EBITDA. Sounds cool. I'm not sure. I'm not a big EBITDA fan, but EBIT or EBITDA is fine. Either one. For times interest earned, use EBIT. Why? Because we want it before interest, because we're trying to see, do they have enough earnings before they pay interest expense to be able to pay the interest expense? And we have it before taxes because interest expense is tax deductible. So we're trying to see, you know, can they pay their interest expense? Here's the only place I'm going to give you a rule of thumb. And the rule of thumb is if you're above 10, there's no problem. And that's all you have to say. You almost don't even care about the trend. So if you were at 30 and now you're at 25, no problem. All right. If you're at 50, now you're at 48, not an issue. Now, if you're at 40 and now you're close to 10, you might say, you know, it's still strong, but the trend has been declining. That's when you might, but yeah, if you're going 50 to 40, 50 to 30, it's just, there's going to be noise because the earnings are going up and down. All right. So 50 to 30 is not a big deal. So if you're well above 10, it's not an issue. Between 2 and 10, that's where you really want to look at the trend. Between 2 and 10, it's okay, but if they were 8 and now they're 3, you're starting to get kind of concerned. Okay. Below 10, below 2, that's a warning sign that they're starting to have some trouble. They may have too much debt, too much interest expense. All right. So pretty straightforward. The second one is how much debt that they have. Where is it? Okay, here it is. I don't know why I didn't bold this. I should have bolded this. All right, so the next one is looking at how much debt they have. So you may have heard the phrase debt to equity. Have you ever heard that before? So debt to equity is how much debt they have divided by their net worth. It's a terrible ratio, but it's the most popular one in academia. So you probably should know it. The reason I don't think it's a good ratio is my guess is if you go buy a house, you're going to buy a $300,000 house. I bet they don't divide it into your net worth. Your college students, what's your net worth? It's probably not $3 million, right? So the college student's net worth might be negative. So you take your debt divided by your net worth, that's not a good number. I bet they're going to look at your debt versus what?
income.
Your income. Makes a lot more sense. The same way with corporations. So a much more, why academia uses debt to equity, I don't know. But in reality, we use debt to EBIT or debt to EBITDA, which is a much more common. I was talking to my friends at Victory Capital and it's like, yeah, they always use debt to EBIT or debt to EBITDA. So your total debt to your earnings, higher, now remember on times interest earned, higher is better. On this one, higher means they have more debt, so that would be probably more negative. All right, so don't, you know which direction you're going. Here's where you're going to really compare into the industry. Because industries use different levels of debt. Some industries use a lot of debt, some industries use very little debt. So your firm's debt to EBIT might look really low versus a utility company, but might be really high for a technology company. So here's where you're going to look at your competitors. This is also a chart where you'll probably more than likely kick out the 0.1 and 0.9 lines because they usually create noise. You just really want to look at your company versus the median. Look at the trend. Is the debt going up? Is it coming down? Are they above the industry, below the industry? Pretty simple stuff to do. All right. So let's look at Walmart. This one's really pretty straightforward. So next, we're looking at solvency, their times interest earned. See my title? See how I do it? Debt coverage in line with industry, then what I'm covering. Okay, see how that works pretty well. In line with industry, well above 10. It's strengthened here recently, but not a big deal. So times interest earned, we see Walmart's ratio has been strong and in line with industry. Walmart's ability to cover interest payments is not a serious concern. This ratio is well above 10. Most of y'all can probably almost use this Walmart wording almost verbatim if you want to, because if you're well above 10, you can almost just keep that. Any question on times interest earned? So higher is better, above 10 is strong. Any of y'all see your company below 10? You did, Alex, how?
Yeah, so from 2015, it was at like 20, and it looks like it's above 20, and then like all of a sudden 2016, they jumped down to like negative.
All right, so if you have a negative number, what that probably, okay, all right, I'm glad you asked that. All right, so we got a problem we have to fix here. There's two reasons this number might go negative. Earnings are negative, or interest expense is negative. Can interest expense be negative? And it can be because the accountants mess this thing up. The accountants on the interest line, they take interest expense, but they subtract interest earnings. So Alex, go to your print page 1. Boy, I'm so glad Alex asked that question. I should give him A for course for just asking that question, but I'm not going to do it. Line 7. If your line 7 interest expense is a negative number, you don't even show the times interest chart. All right, now is your line 7 a negative number? Yeah, you just say times interest earned is not an issue for this firm because their net interest expense is actually an income. They have more interest income, they have interest expense. Don't show the chart, don't show the negative number, you're off the chart.
What if it's positive?
Huh?
What if it's positive?
Well, if it's positive, that's when you do the times interest earned. You look for the 10 or higher. All right. If your line 7 is a negative number, you don't even put the chart into your, now it causes you one series. So Alex, look what the problem you're going to have is you're now going to have to renumber all of your charts. So that's the
Same thing that Facebook, all numbers are negative and the big negative.
the interest expense.
Yes.
Yeah. So you just don't even show chart 5.
We don't write.
You just mentioned not an issue because their interest expense is actually a net interest income. Yeah. Yeah, boy, that's a perfect question. I forgot about that. Yeah, that's very.
What if it's NMS,
The times interest earns MFF or the growth rate?
the interest expense, like the online side of the,
The whole line is NFF?
like the CAGR.
Yeah, the CAGR you don't need on this at all. You just ignore the CAGR. Yeah. That's one where it may have been net interest income at one point, and now it's interest. Probably likely in that case, it used to be 0.
Yeah, it used to be really.
Yeah, if it's 0, you'll get an NFF. So then you don't need the CAGR on times interest earned at all, though.
So just to make sure, so you said I don't need chart 5 and then I would have.
Yeah, you would probably do something like this. You'd probably, and you'll take the chart out and you say times interest earned for XYZ. This is not an issue because their net interest expense is actually income, as you know, their interest income is greater than interest expense, and you're off the chart. All right, without my typos. Okay, Pretty sure. Huh?
So chart 9, yours is talking about retail, it's where it's like.
Yeah, we're gonna get to that next,
Oh.
next week. Yes, a lot of y'all are gonna have issues with that, and I'll fix it for you, don't worry. Okay, so
So my interest expense is positive, but like the numbers for each year are in parentheses. Does that mean anything?
oh, I don't know what you mean by that.
Like the numbers are positive, but they're like, they have parentheses around them and they're not negative. Oh, that means negative, okay. So
Yeah,
they're
that
not like
would be
negative
negative,
sections,
yeah.
parentheses.
And your times interest earned would be a negative as well. Now, it is possible your times interest earned because their earnings is negative. Again, you wouldn't show the chart. They're obviously, if they're losing money, they can't pay their interest expense because even before they pay their interest expense, they're already losing money. So then, obviously, I try to pick firms that don't have losses, so that should not be an issue for you all.
So for me, 2022 retail expenses negative, but the years before, they're also.
Yeah, on something like that, all right, so let me show you in the Excel spreadsheet. But you're asking really great questions because it's helped me. So on the Excel spreadsheet, you have this page called data for graph building. So let's say, Aphrodita, I'm going to find the times interest earned. Let's say Walmart was actually a negative number the very last year. Where'd it go? All right. And it didn't do it. Why didn't it do it? Still didn't. Times interest earned. Oh, all right. So let me show you why you have to take these lines out. All right. So the two debt charts, you'll have to take the 10. All right. So after you, let's say you had something like that. There's a couple ways you can do this. One is you mentioned that it went from interest expense to interest income, and then in the data for graph building, you just find that culprit, and this can be true for several other charts. You have 1 year that's just horrible. You can just go and watch this, hit the delete key, take it out. Or even something else that could even be better. Let's say a previous one was like that. So you have something like that. So you have charts like that. What you can do here is you see that 1 year looks bad. You just go to the data for graph building, find that 1 year and just hit delete. And that's perfectly fine chart. All right. So if you see something 1 year, especially one horrible year where it's 10,000, when everything else is, 2 or 3, just delete that 1 year. All right. You can take it right out. So that data for graph building is pretty good place to know that it's there. And y'all like setting up the perfect questions, things I meant to talk about and just forgot about. So perfect. All right. On debt to EBITDA, you notice here I took out the 0.1 and 0.9 on that. You probably will. First of all, the 0.1 is most likely to be on the zero line because there's a lot of firms that don't have debt. So you don't need a line that's just all zeros. That doesn't make sense. And then the 0.9, that's where you have firms, they may not have a lot of debt, but they just have so little earnings that it just looks like a massive number. Now, what if your firm, so who's doing Lululemon? All right, so you got a 0 all the way across, all right? So I think they had a little debt here recently. I can't load Lululemon. So if your company is 0 all the way across, you could leave chart 6 out. You could leave it in with your firm on 0. You have to decide if you really need to put that chart in there, if it's really telling you anything or not. Now, Triana, if it was 0 through 2020 and then it started rising, I would leave the 0 in there and show it rising and just mention that they used to not have any debt, but recently they've started adding debt. However, they're still well below the industry. All right. Now you can see with Walmart, they were above the industry and then recently they're back below. So that's what I said is going on here. All right. So again, you're looking at where they are from the industry and then the trend. Are they going up or coming down or flat or whatever? So very easy to do.
How can debt to EBITDA be negative?
Okay. Which firm are you doing?
These
Okay. Visa. Okay. So there's two debt numbers. There's gross debt and there's net debt. I use net debt. What net debt is, they take their debt and they subtract cash. So Apple's a good example. Apple has more cash than they have debt. So their net debt's a negative number. We may be able to fix that. I might be able to substitute in gross debt instead. But more than likely, I mean, you have to look on the debt, is the debt line itself showing, I'd have to look at, if you have something like that, you may have to email it to me and let me look at it. You know, with Apple, it's true Apple has debt, but the reason Apple has debt is not because they need cash. It's because their cash is trapped in Europe. If they bring it back to the United States, they're going to pay massive amounts of taxes on it. So what Apple's decided to do is leave the cash in Europe and borrow money in the United States to pay their dividends, which kind of makes sense. But what that means is their debt, they don't really have debt. You know, they have, I don't know, $50 billion in debt and $200 billion in cash. So in that case, I would just leave the chart out. They don't really have debt. So it's possible. I don't know exactly, Luke, on your case, but I think that's probably what's going on. Because I can't imagine Visa's ever had negative earnings. So it's got to be the debt that's negative. Other questions? You can see why you're asking great questions, because each one of your companies has something unique going on, right? So everybody's going to see something, and so every company's a little different. Okay, questions on solvency. That seemed pretty simple, right? Times interest earned, higher is better or lower is better? Higher is better. If it's 23, what would you say? Really good, really strong. If it's 1.7, having a problem, you got to talk about it. All right. Debt to EBITDA, higher better or lower better? Lower better, especially compared to the industry. Okay. So you get, I mean, it's some of the stuff is not that complex. You just got to know to look for those numbers. So, all right. So that finishes solvency. So now what we want to do is summarize the short term. We got liquidity, we got solvency. We want to bring it all in together. So how will we do that? Well, I have this third. I don't think this third really belongs here. I really want it to be the summary of the whole section. I say third is under solvency, but it really goes under the summary. So this is unique to me. This is kind of, I showed you that that book on I forget what it is, that accounting book, forensic accounting, trying to see if management's playing with the numbers. This is my one place to do this, and I do it in a really unusual way. But what I want to do is say, and if you look at let's look at the chart, because that's probably the best way to do this. So what the chart is cash from operations. Each one of these lines is cash from operations. All right. The blue is their net income. So I'm taking net income and getting the cash from operations. And what I'm trying to figure out is, was there anything unusual going on from that trip from net income to cash from operations? Because if management is lying on the books, if they're doing something unusual, there's probably going to be some disconnect between net income and cash from operations. So what's one thing you always add back to net income to get the cash from operations? The most obvious thing is depreciation and amortization. That should be a very stable number. You notice with Walmart, I took net income and added back depreciation and amortization. Very, very stable number. All right, that would you expect. I doubt any of your companies have depreciation going up and down. The next one is working capital. We just talked about that, changes in receivables and inventories. If inventories increases, what happened to cash flow? See if you remember your accounting classes. You increase your inventories, your net income doesn't go up, right? Because you didn't sell the stuff. It didn't affect your net income. The cost of goods sold didn't go up, but you bought more inventory. So if inventory increases, that's a cash outflow. What if accounts receivable decreases? What is that? Cash inflow. All right. So if net working capital is declining, it's going to add to your net income to get the cash flow. If net working capital is increasing, it's going to be a cash drain. You're probably going to see that jumping around a little bit. What you don't want to see it is a massive negative number at one time. You know, inventory really, really jumped all at once or something like that. That's when you worry that management's got something going on, that they're propping up their net income. And Evelyn, I don't know what Netflix is doing because they're a bizarre company.
So what is the differences? Because
The other is everything else, and that one can be massive. All right, so other is usually one or two things, but it depends. It can be a pension contribution. So what is your firm?
UPS.
Yeah, UPS has a massive pension plan, so yeah. The tax code is really bizarre. USAA, we would fund our pension plan maybe every 5 years, and it might be $400–500 million. So that comes out of cash flow, but it doesn't affect net income, so it's a massive expenditure. The second one's a little trickier, and that's if they sold the subsidiary and made a gain off of it. So let's say they sold the company and they made 400 million. So the way that works, see, we have time to do this. So let me try this. I probably shouldn't try this, but let's say you sell a sub and you sell it for $1 billion. Its book value is 400. So your gain is what? 600. That's 600 goes into net income. Is that a cash flow? Well, what's your cash flow here? How much cash you get on this? No, you made $1 billion, right? So this is going to be a cash inflow under cash or investing. And that's your true cash flow. But net income's up by $600 million. So how do you get from net income to the cash flow? Well, this 600 is in net income. Remember, cash from operations equals net income plus and minus adjustments. Our cash flow is $1 billion, but it's in cash for investing. We don't want it in cash from operations. What's in cash from operations right now? It's 600. So what do we have to do to get the cash from operations? We would have to subtract that gain from cash from operations because we already have the $1 billion in investing. All right. So if you sell something for a big gain, it's really hard to, it's really wacko, isn't it? But you would actually, that gain you made on the sale, you would actually have to subtract that from cash from operations because you already have the full $1 billion in investment. So sorry, I mean, accountants are trying the best they can. Their goal is not to make it simple, though. All right. What if they had a loss, though? What would happen there? They had $1 billion in cash, but their net income's down 600. Then you would add it back. So it's probably one of those two things. For yours, it could be a pension plan. How do you find that? You go into their annual report, you find the cash flow statement, and you're looking for a line to jump that year. You try to figure out that was it. If it was a pension funding, then you know that's what it is. But these realized gains and losses are really easy to find because they're their own line. So you can find it. I'm not saying you need to do that, but if you see that and you want to know why did they have 1 year that just really jumped, all of a sudden, like 2020, that's going to be working capital. Maybe it's an inventory thing. Who knows what's going on there? All right. And then the last thing we do is credit ratings. So I have my overall assessment. Walmart's doing pretty well here. You have to put it into your own words. A lot of students use too much of my Walmart language here in the summary, but they're very liquid, right? Because they have their working capital requirement is a source of cash. They've been sending a lot of money out to stockholders and bondholders. Everything's looking really strong. They were having some issues with debt when they borrowed money for Flipkart, but that looks to be back in place. So I think they're really good. And oh, by the way, the rating agencies agree with me. They gave them a AA rating. All right. So I have the definitions for credit ratings in the class notes. You can go use the S&P definition. It's the most crisp one. What would be a bad credit rating? So anything that's BB or below would be bad. BBB is okay. That's investment grade. BBB. So Netflix was BBB. That's okay. It's not wonderful. So AAA, AA, single A is wonderful. That's high quality. BBB is medium quality. BB and below doesn't mean they're about to go in default. BB companies are okay, but they've got something going on. So if you go, hey, my firm is wonderful, great liquidity, great solvency. I think they're wonderful, and their credit rating is single B. You might want to rethink your assessment, because you've got a really good analyst out there disagreeing with you strongly. And then the other thing I gave you for those of you that don't have a credit rating, which is quite a few firms, like Lululemon. If Lululemon doesn't borrow money, they don't have a credit rating. So what I give you is Bloomberg has a really good statistic called the 5-year probability of default. Lower is better. And it has a high correlation to credit ratings. And you can see from Walmart, they give Walmart a very, very, very low probability of default. Another consistent. So if you don't have a credit rating, you just state my firm doesn't have a credit rating. However, I use looking at the Bloomberg probability of default, blah, 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 blah. Okay. And we went through that last part fast. I might reiterate it next class. What I wanted you to try to get through this chart this weekend. Okay, get through chart 8 this weekend. Do your best. If you want to meet with me on Monday, as far as you got, that's fine. If you want to set up a Zoom this weekend, we can certainly do that. And I'm not sure any time you want, but get that part done. And that's really more than half, because you're knocking out one of the hardest part. Any questions on anything? Everybody's good? Everybody's got their data? All right. Okay, I'll stop it there.